Okay, so welcome everybody. This is the Central Florida Options Meetup Group. We've been remote now for pretty much going on our third year being remote. So it's been great to have some new people from outside the area, as well as some of the local folks. So today, what I wanted to talk about is some earnings trade strategies. So, and I'll just start off by saying that I'm not an expert on earnings trades, but I think they're a great strategy, particularly in this kind of market where, it's a tough market to trade. And I think this is a great alternative to, zero DTEs and things like that. So just wanted to share with what I've learned on it so far. And definitely, if you guys have questions or feedback, please let me know. Okay. So again, this is going to be hopefully an interactive group. So if you do have questions, don't hesitate to just ask away. So, the first thing, mostly everybody probably knows this, but every company generally announces earnings every quarter. So, 4 times a year, every company has to, report their earnings, revenue, and a lot of times what they project going in the future to their shareholders and analysts. And that really provides a trading opportunity for us option traders. And really, there's a couple of good reasons why it's a good strategy, at least to consider. One is, as a stock comes into earnings event, the implied volatility is elevated. And so you'll see, a lot of times over 100% IV, which makes the credit really good for the risk. And then the other thing is that after the earnings event, the IV will revert back to the mean, or IV crush. So if we're selling options going into earnings, after the earnings event is over, the IV generally reverts back to the mean. So the other kind of important thing, or I think is to our advantage, is there's really great historical information about previous moves after earnings for each company. So we can see, going back pretty much as far as we want to go, how much a stock has moved after earnings. And we'll see, how often do they go up after earnings? How much did they go down? Did they have big wide spread, moves, or are they all compact? So what that really kind of boils down to is that they kind of lead us to really good, quick trading opportunities. And we can set these trades up as a defined risk trade or an undefined risk trade. I choose to do them as a defined risk trade. So that's kind of the reason that I like earnings trades. And again, I'm not an expert at it, but I've been working at it probably for a couple months every day to kind of refine the strategy. Any questions so far? Okay.
Are you gonna print out something and leave it on Facebook, or?
Yeah, I have
Okay.
the PowerPoint. I'll get it to anyone who needs it somehow. I can put it on the Facebook page, but we'll get it out to everybody as well as the recording.
Brian, your defined risk versus what? Naked?
Yeah, you could do basically sell a straddle or a strangle if you wanted to do this as an undefined risk. But I generally will set up the trade. I'll show you in a little bit, but how, we'll do it as an iron condor or an iron butterfly. So, so that they're defined risks, knowing that, if the trade goes against us how much we actually have at risk.
Okay.
Okay. So here's kind of the basic steps. And it's really, once you get the routine down, it's a pretty easy, straightforward process. So the first thing you want to do is identify, bless you, eligible stocks. And we'll talk about what that means is in a bit. But and the second thing is once you've identified the stocks that are coming into earnings, what you want to do next is review the historical data involving the moves. And there was a question on there about, let me see if I can bring it up. Is there any demonstrated correlation between past earnings moves and the next one? And the answer is no. I mean, we don't know. Nobody knows exactly how a stock is going to move after earnings. But what we can figure out is what is the largest move that it's ever made in the last 2 years, 4 years. So so that data is very helpful. And I generally do non-directional trades because you don't really know which way it's going to move. Even you could take a bad stock and it has great earnings. You could have a great stock and it has bad earnings. So what you try to do is kind of minimize the risk by being non-directional and trading outside the largest historical move that the stock has made. And once you've kind of figured out what's the historical record of that stock, then you want to go ahead and look at, what are the option chains that you might be able to sell options and make money. So in terms of eligible stocks, the biggest thing is you don't want to trade illiquid stocks for earnings. So you'll want to make sure that whatever strikes you're settling on have enough open interest so that if you need to get out of the trade quick, you certainly can. The other thing that I would say is I have not had any luck trading stocks under $50 that are trading at $50 or less. So I would say at least $50 or more. And you want to trade stocks that have, relatively good fundamentals and stocks that you know and have kind of heard of before. And so the ideal thing would be if you find a stock that has if you find a stock that it has an expected move of say 8% and it only trades at historically at 4%, that's probably your ideal stock. And the last thing in terms of eligible stocks is I prefer trading trading weekly options because I don't want to be in this trade more than say a week. And except for the monthly, the third week, you can trade all the monthlies. But so those would be what I consider eligible stocks. So any questions there?
Do you prepare a scanner yourself to come up with some of these stocks?
Yeah, we'll actually walk through that. I use, there's a couple of really good websites. One is called Option Slam. And it has a way that you can kind of scan out, what stocks are coming up for earnings, what their previous history is. Another one is hopeofslope.com. It is shows you kind of historical, it has a calendar. Another one is Earnings Whispers. That doesn't really give you a lot of historical data, but I think Option Slam is about the most helpful in terms of identifying what stocks are coming up, what their history is, and going from there. so the process. So once we come up with a list of stocks that have earnings either tomorrow morning, or what I generally do is during the day, I will look through and find stocks that are announcing earnings after the close or before the open the next day. And I really haven't seen any difference between before the market opens or after the close in terms of profitability. I don't know if anyone else has, but so anyway, I come up with my list, and then I kind of make sure that they have weekly options. And then I spend a lot of time looking at the historical moves. I also look at the expected move, and I will use whichever is the greater. So if the historic move has only shows, say, a 5% downside in history, but the expected move is 8%, I'm going to use 8% or more. And then in terms of trying to determine the best strategy, if the stock has really it always has solid earnings, and beats earnings, I may be looking at put spreads. If it never beats, I'll probably look at a call spread. But most of the time, probably 90% of the time, I'm setting up an iron condor if the credit is enough. So, and what I mean by that is we would sell a put spread and a call spread on the trade going into earnings. I've also experimented using an iron fly, which means selling the at-the-money put and the at-the-money call, and then adding wings on the end of that. And those have done fairly well, but I've done better on the iron condors. Okay, so, and in terms of continuing the process, so again, I'm looking at pretty much the last 9 quarters. So the last, 2+ years of results. You can go back further if you want. And sometimes I do if the results haven't been, maybe just want to make sure that there wasn't a quarter that was even worse or better than the last 9 months. But generally, we'll look at the last 9 months. And then what I will do is kind of, if it's neutral, and most of the time they're neutral, I'll sell an iron condor. So, and here's just a quick, this is a spreadsheet that I use as my kind of worksheet to set up to look for trades. So these are recent ones. This is a trade, the last one here on BBY. That's a trade that I put on yesterday. So what I did here is I write the data down. So what was the EVR? And I'll talk about that in just a second, but what the IV is. So the IV percentage for BBY when I put the trade on was 203%. And that comes off the option chain. I look at the up results and down. So it was up 3 out of the last 9. I trade, what was the stock trading for when I put the trade on? And here's the expected move, which was 12 points up or down. And then I look to what was the largest up move, which was 12%. And the biggest down move was 16.7%. So my spreadsheet would calculate what's the dollar move. So on the upside, it went up about $9. On the downside, it went down $12. That was the biggest move out of the last 9 quarters. So then I will calculate what's the minimum call and the minimum put that I will sell. So here's the actual trade that I put on. I sold the 55-50 put spread, and then I also sold the 90-95 call spread. And for that, I collected 73 cents, and I had at risk $4.27. So if the stock moved beyond 95 or below 50, I would have been, had a bad loss. So we actually put that trade on yesterday. And of course, the earnings were, way less. I don't know exactly where they ended up, but way less than the expected move. So it was a nice profitable trade. Any questions on the sheet or just the strategy?
Do you close at a particular profit percentile, or do you wait for the expiration of the week?
It kind of depends. If it really is so, centered between the two strikes, I will let it run and let it expire. If right off the bat, I would generally set an exit for about 5 cents.
Thank you.
Mm-hmm. Okay, so
What
here's
date did you go out to for it? I'm sorry,
go ahead.
I was just asking what date you went out to for the trade.
Oh, yeah, it's a great question. I use on Monday, Tuesday, or Wednesday, I'll use the Friday expiration. Thursday and Friday, I'll use the following Friday expiration.
Okay, so usually about 5 to 7 days.
Mm-hmm. Right, yeah. So that one yesterday, I put it on yesterday. I used Friday's expiration. Anything I put on tomorrow, well, I won't have any. I didn't find any good option earnings trades for tomorrow, but Thursday I'll use next Friday's expiration. And great question. So in terms of EVR, it's just a report that shows what is the earnings volatility rating, which just kind of says how wild can the swings be. So they go from 0 to 10. So if there's a stock that is probably over a 5, it's probably got these wild swings. So probably not a tradable, stock for earnings trades. But if it's, 1, 2, or 3, and the earnings, I can trade within the greatest move, then that's what I'm looking for. So that's what the EVR is. And so
where do you find the EVR?
It's on Option Slam is the only place that I've seen it.
Okay, thanks.
Yeah, I mean, but without the EVR, you can, if you still have the historical data, you could pretty much guess what the EVR would be, just because, if it's moving, 25% up or 30% down, it's a hard stock to trade options for the most part. So in terms of trade management, I mentioned it earlier, but after earnings, that stock's going to move one way or the other. You never have to worry about that. It's going to either go gap up or gap down. Very rarely does it not move much. And so what, if the stock move is right in our wheelhouse between, our strikes, then we can either let it expire for a full profit, or we can just get out of the trade for like 5 cents. If the stock moves against us, what I've learned is you want to give it some time, because if a stock gaps up, very often you'll see after the open that the stock will pull back, mainly because profit takers are jumping in. And the other thing is, if it gaps down, sometimes I'll get out quicker, because if it's a bad trade and it gaps down, if it had bad earnings and it gaps down, it's probably not going to recover. So that's my caveat there. So, and Pierre asked, what's the win rate on the iron Condor strategy? I'd say it's about 80%. So, so that's the way they have been working. And I'll show you some numbers in a second. Any other questions about the trade management?
For the iron Condor, do you leg in and leg out, in the sense, do you go one side first and the other side later, or do you go together?
To get in the trade?
Get in the trade, yeah.
Yeah, I generally like to get in at the same time, However, if I have a hard time getting filled, I'll enter them as 2 separate trades. And I generally enter these trades around 3 o'clock in the afternoon before the close, so that I'm waiting pretty much the whole day for whatever the stock's going to do before earnings, and then put the trade on. Because what you don't want to do is set the trade up at, at the open, and then the stock moves, $3 or $4 during the day, and then your numbers are kind of a little askew. But I found, for the most part, if you're trading, pretty good, good liquidity, good open interest, you should be able to get both the put and the call side pretty much filled pretty quickly without any trouble. So here's the trade on BBY. So I looked at, it was trading about $72 a share. And in the history, the biggest move up was 12%. The biggest down move was 16.7, which would have put us probably somewhere between a 60 and an 85. And I went out even further because of the retail stocks that had really just gotten hammered. So I'll push it out as far as I can to still make between 10 and 15% return on the trade. So in this case, I sold the 55.50, the 90.95, collected 73 cents, and I was able to close it today for 6 cents. So that's kind of when the trade works well for you. The key points on the trade are, generally they're going to last 2 or 3 days at the most, unless you let the trade expire for a full profit. You should be able to get out of the trade for the most part the next day or the day after that. So they do have a pretty high probability of winning. I generally won't take a trade unless it has an 80% probability of profit. I like the defined risk aspect of the trade, and that, when I put the trade on, if the trade goes totally against me, I have a defined, I know how much I have at risk. And it's a pretty scalable strategy in that, you can, start with one contract. You can do, 10, 20 it's at whatever size you want to trade. It's very scalable. And probably the main thing that I would say is, once you have a process where you can select, figure out what stocks are coming up and do the research, set up, make sure that the trade is, going to make, set up outside the, the expected or even the widest range. And then, so once you've done all the homework, it's just a matter of putting the trade on. So, so that is the strategy for my trading earnings trades. And then what I can do, if you guys are interested, I can show you a couple of the different websites that I use that will, that you can use to do your research. But any questions? Do y'all like this strategy?
Yes, I do like it. Any chance of back testing or anything done on this? How long you have been trading this so far?
Well, I've only been trading this strategy a couple of months and doing it in small size, just to kind of get the feel for the strategy, when it works and when it doesn't work. So, and I tried to do some back testing. I think the only back testing you can really do is looking at the history to see how far, historically, how far has this stock does it tend to run after earnings?
Okay. Do you mind sharing any of your upcoming Thursday item or Thursday stock?
Yeah, I can do that. I've started to do my research on it. So yeah, I'd be happy to do that. So we can actually walk through that if you guys like. And this is, there was a question about the risk. If you get 73 cents on a $5 widespread, you have the potential of losing, $427. That's the same pretty much on any credit spread. And so, yeah, that's true. But the probability of that happening are pretty small. So especially if you kind of set your strikes correctly or as conservatively as possible. So it doesn't always work, but when it doesn't work, you're able to get out of that trade pretty quickly without a catastrophe. I think as long as you're not picking stocks that can just totally go up 50% or down 50%. You don't want to be trading those kinds of stocks. Any other questions? And if you want to type them in, that's certainly fine. And the question is, do I have a max loss point? So what I try to do is I'm setting up what I will do the number of I have a number that I don't want to lose on any one particular trade. So I will set the number of contracts based on that loss. So you can actually, you don't have to do a $5 wide spread. You could actually do, say, a $2 wide spread or a $1 wide spread on some stocks, or 2.5 is pretty common. So you can set it that way, and then based on the amount that you want to risk per trade, determine the number of contracts. Hope that answered your question.
What kind of fundamentals do you use?
I don't really, other than making sure it's a stock that I know of, I'm strictly trading it based on the expected, the historical move of the stock. Now, if it's a stock that I know has, that I like Snowflake, I wouldn't probably trade that through earnings. Big, volatile stocks, but there's plenty of really good, fundamental stocks that come up for earnings that you can apply this to. But I don't go through and say they've got to be strong, super strong fundamentally, because this is based on pretty much that they have implied volatility spiking, and we know what the history is. Did that answer your question?
Yes, thank you.
Okay. And again, these are trades, for the most part, you're going to be in it for, you'll put the trade on today, and hopefully you're out of the trade tomorrow. So that's kind of the nice thing about this strategy.
How much does the IV crush help your profitability?
Oh, it helps a lot, because remember I showed you that one IV had like a 200% IV. Well, as by the time the morning is kind of run out, that IV should be, about half of that. So that's really a big range, big help to the strategy. It's an IV crush strategy. And okay, so another question in here was, could you use a stock like MDT and show how you look up data on those websites? Yeah, so we could look at MDT. Let me just write that one down so we could look at that one. Another great question is there a range of IV that you look for or stay away from? So the only thing I would say is, if it's too low, if it's 30 to 40 to 50% on the IV, you're not going to get the IV crush for the most part. But I don't really rule anything totally out if their IV is low or lower, especially if I look at the IV range or the IV ranking. So, if the numbers don't work because of, if the IV isn't there, the numbers may not work out. So in terms of reaching a minimum of 10% return on risk. So that's my criteria. And I really got that from, I don't know if any of you guys have heard of Crowder options. This is a lot of this strategy is totally based on his option trading or earnings trading strategy. Okay, did I answer everybody's questions? Okay, so what I'm going to do now, let me get out of here. So I will have the slides and everything put up for everyone. Let me show you guys Option Slam. So, okay, so let me go ahead and share my screen again. Has this been helpful?
Yes.
Okay, so here's Option Slam. And okay, so there's a couple things that I'd like to do in terms of my pre-work. So the easiest thing to do is when you go up here to earnings, they have a calendar section. So all I would be doing is I click on, I already know there wasn't anything today, but let's look at the 25th. And I would choose stocks with weekly options only. And then I have that minimum of $50. So then all I do at that point is hit the submit. And then here's the options that come up for either before the opening on the 25th, I'm sorry, after the close on the 25th, or before the opening on the 26th. And so you have the, the stock name, what the EVR is, what the price movement of the past month and the past last earnings. And so then if you click on this, it will bring up all of the data on the stock. So if it has here, what is the implied move for the week? 10%. So what I will do is I use this number or the number in the option chain, whichever is higher. So that's how I set the expected move there. And then what I'll do is go down here to the earnings history. So then I really look at what is the max, so here's some, let me just walk you through this. So this is what the open after earnings was, what the high, what the low, and what the close was. And then it shows you what was the close the day they announced earnings. So it shows you they were up 7.5, and the max is what was the worst it was during that day, or the best. So it closed 7.5% down, but it was down 8% at one point. So what I use is this max number. So that makes me as conservative as possible. So what I'll do is I go through here and say, what was the best quarter? 12% up, and the worst was 9% down. And if you want to go back further, you certainly can. You can go back, all the way to, 2019, 2017, it goes all the way back. So if you want to, do more data, but I think the last 9 quarters gives me enough information to consider making a trade. Does that make sense, everybody?
Yes.
Okay, so this is a great source for me that it sets up what's the worst it's done and what's the best it's done. So then all I do at that point is start to see how far out of the money I have to sell put spreads and call spreads to be outside of those ranges. So that's kind of the main source that I use. Now, let me show you.
Can you show EVR on this screen, please?
Oh, sure. Yeah. So here is the EVR.
Oh, okay. Thank you.
Mm-hmm. And so the other thing is if you run the calendar like I did, and you just pick, it will show them all listed here. So, if you see something like Snowflake has a 5.5 EVR. So that one is probably, I probably wouldn't give that much thought. The other thing on something like Snowflake is it only has 5 earnings. It doesn't have any history. So we don't need to trade something we don't have a lot of history on. And the only other thing is if you go through these, what you'll find is sometimes it'll be a great stock that you like, but you have to go so far out of the money and to you don't get enough credit, or there's not enough liquidity in the options you want to sell. So what I kind of do is just plow through the list. I would throw out, the ones I would throw out in this particular case would be Snowflake for sure. And some of the others probably, I would at least run the numbers. And here's the Medtronic number. So EVR of a 1.4. So that's a nice conservative stock. And you can see here, their earnings moves are all, the biggest up day was 5.7. The biggest down day was 4.94. So, and when I say 5.7, it finished the day at 2.5 up. So we're going really far out of the money when we use the max percentage. So what I would do on a stock like Medtronic is I would, figure out what it was trading for. And then I would calculate how much do I need to sell out of the money. So if it was right now, Medtronic is selling for 105.60. So if you add, 5%, then you'd have to sell at least the 112 to be outside of that move. And you do the same thing on the downside. So does that help? Here is, let me find this sheet. Okay, here's my earnings worksheet. Okay, this is actually my results since I started this in early April. Is I have the stock. What was my return on risk? So in April, I did really good. I had a total of 270% return on risk for all the trades. I had an 89.5% success rate or win rate and 15% return on risk per trade. So that was a great first month. Now this month has been a little tougher, and that I am at, let's see, 56% total profit, averaging about 2% and have about a 76% win rate. So that's my record so far. So I didn't run them, I didn't average them together. Let me see if I can find the sheet that that I calculate my trades on. So okay, so here's here's what I kind of built just so that I don't have to write the numbers over and over again on a piece of paper. So what I would do is, and here's Medtronic for you. I actually started to run the numbers on it. So I did, and that's right down here. So I'll just highlight it so we can all see it. So it's the EVR is 1.4. The IV was 55, so that's pretty low. It had, I think it was 4 out of 9. So it had, it was about a 50-50 shot whether it was going to go up or down. The expected move was 4 points based on the option chain as well as option slam, whichever was higher. The biggest move up was 5.75. And so it'd be at least $6. We'd want to be out of the money. On the downside, it was down 5%. So it'd be just a little over $5. So I'd have to sell something under $99 or over 112 to put this trade in. Does that make sense?
Yes.
Okay, so that's how I do it. And so, so my homework before the end of the day, before 2 or 3 o'clock, is to go through all of these stocks and calculate which one, kind of makes the grade. So here's what I did. Here's what I did for today, and none of the stocks worked out. So I didn't do it any earnings trade today. Here's what I did yesterday. I looked at these guys. This is the only one I put on, BBY. So that's what I use to kind of work through the option chain. So does anybody else trade a lot of earnings?
And what question, please?
I said, is there anyone in the group that trades earnings? I know, Bill, you do a little bit, right?
I've done a few, yes.
yeah.
I've lost on 2 and made money on 8, I think.
Okay, yeah. So I think the key is on the 2 that you lost, hopefully they didn't, eat up the rest of the money on the other 8 winners.
Right.
But, and that's usually, it's not usually the case. So especially if you, are very conservative in setting your option strikes.
Brian, on that option slam, where you had several opportunities and you picked BBY, is it because of the 203%? I saw that row.
Yeah, I mean, really, it was just because, one, I was able to go so far out of the money. No, let me just show you. Go back to that screen just so we can. So here's the BBY. The minimum put was $60, or $60 put would be the minimum we did. I actually dropped it another $5 out of the money. And I think I also went up $5 on the call spread and was still able to get, a nice credit of 73 cents. So I could have got a lot. I could have got a lot more if I'd done a 60, 55 or an 85, 90, but I don't want us to be sweating it out if it's too close.
Mm-hmm.
Your screen didn't change on my computer. I don't know if it's
okay. Let me shrink this thing.
I see it. I don't know if others see
okay.
it.
Is that better? That's the whole screen.
We can see it. I don't know if Bill can see it.
Okay. Bill, is that any better?
I don't know what's wrong with my video.
Okay.
Yeah.
Well, I can share this slide with anybody that wants to use it. It's nothing fancy. I just will use this. When I first started doing them, I was writing all the numbers down and calculating the risk. Because the other cool thing is on this one, if I'm getting ready to put the trade on and I've run the numbers in the morning, and now maybe the stock is $75. So it will automatically change all of the expected moves based on the expected move. So
Oh, that's great.
so it just made it a lot easier, because if I do the work at, say 8 o'clock in the morning, and now I'm looking at them at 2 o'clock, all those numbers are going to change. So I said, I got to come up with some way to make it easier to not have to rerun all those numbers. And then I'll wait till about 3 o'clock to put the trades on.
Can you share a template of this spreadsheet, maybe?
This one here?
Yeah.
Sure. Yeah. Send me an email and I'll send you a copy.
Okay. And also, can we maybe go through an example of an iron fly?
Sure. Yeah, let's do that. That makes good sense. So let's, okay, so let's do Medtronic. So I'm going to share my screen here. Okay, I'm going to share my option chain. So here is, okay, here's Medtronic. So if we were going to do an iron fly, what we're saying is that So here's the expected move. About 3.68 is what they expect. So if we were selling an iron fly, we would sell the put and the call at the money. So 105. So we would again be doing this at 3 o'clock, wherever it's trading. So this is just a plain straddle. We're selling the 105. So then what I would do is I'd go in here and I'd buy something 5 wide on top of that. So this, whoops. So this would pay us instead. So it's an iron fly with wings, and we would collect $3.30 credit. You could go out further if you want, but I would make them even so that your risk is the same. So in this particular case, we would collect $345 per contract, and the most we could lose would be $255. And this,
Do you have Medtronics up? I don't see it.
okay.
At the bottom.
Okay, let me start again here. Sorry about that.
I don't know if it was just me or what.
No, I don't know what I was doing there. So let me
Thank you, Brian.
sure, let me get it up and then I will show it. Okay, so I've been doing these so long, but I still never get the sharing part. Okay, so now can you see Medtronic?
Yeah.
Okay,
Mhm.
perfect. Okay, so here is, let me just start over. So, okay, so here's Medtronic. It's trading for $105, right?
Mhm.
Okay, so if we were just selling each side, we would sell the put and the call at the money. And that would pay us $4.25. However, you have basically unlimited risk. So if this thing went to zero or went down, 20 points, we could lose a lot of money. So the expected move is about 3.7%. So what I would do on an iron fly is I would just add in wings $5 wide. And now instead, so now we would collect $3.30 on a $5 wide spread. So we would be collecting $330, and the most we could lose is 170 on this particular trade.
Mhm.
Did that make it a little bit clearer?
Yeah, and the width of the trade, do you involve
Well,
the
what I would try to
expected
do,
move?
I would try to make it wider than the expected move.
Excellent. I
And
see that.
yeah, so, and there's nothing, you could go 6 wide if you wanted to. I would probably look to see, hey, there's more open interest on the 110 and the 100. So I'd probably stick to that. And so the goal here would be, if Medtronic, say, goes up $3, we'll make money on the trade.
Okay. Because of it being an iron fly, you close it basically as soon as the IV crash is over.
Yeah, what I do on iron flies, that's a great question. So I have a risk of $170, right? So I want to get out and make a 20% return on risk. So I will exit the trade for $34, around there. I would probably exit the trade for like $295. So
Okay.
once the market opens, the IV starts to crush, we should be able to exit that trade. Unless it's moved really far, we should be able to exit that trade within the first hour of the day.
Makes sense. Thank you.
Sure. Great question.
So when do you decide to go iron flies over the iron condors?
Yeah, I mean, if it's something like Medtronic, where you saw, remember, the average move is only 4%, that's a perfect iron fly kind of territory. Most of the time, I would
Makes
probably
sense.
say 4 out of 5 trades are going to be the opposite. They're going to move 10% up or 10% down. So you don't want to do iron flies on those kind of trades.
That makes
So,
sense.
Yeah, a lot of times what I'll do is if the EVR is under 1.5, then I'm thinking iron fly. If it's over that, I'm thinking iron condor.
Makes sense. Thanks.
Yeah, and if we were doing an iron condor, I haven't run these numbers yet, but you know, we would do some. I don't know if they're going to work or not, but so if we and basically same kind of trade, we would just be. That's not right. So I'd be selling the 100, buying the 95, and then on the other side, selling the 110. Buying the 115. So this one, you know, just running it really quick would pay $71 with $429 at risk. So that's kind of the difference between the iron condor and the iron butterfly. That makes sense, everybody?
Mhm.
Okay. So so that's how, you know, I do the trade. So any other questions? So if you have any questions, you can email me or you can put it on the meetup site. But my email is brian.terrycfp@gmail.com. So if you want to get a copy of the slides, or the present, I'll record it down to a YouTube. I'll probably put it, I have a YouTube channel. I'll probably put it on that just for anybody who missed it. And, but before we break, any other questions or feedback?
This was very
No,
good, Brian.
great presentation.
Oh, thanks. So if you guys aren't members of the meetup group, we are still doing them remotely. So if you just join the Central Florida meetup group, you'll get the invitation to the next meeting. And if you guys have any suggestions for future meetup topics, we're always willing to, or anxious to get other presentations, or if you want to do a presentation, contact me. We're always willing to have guest speakers. So anyway, with that, I will let you guys go. I hope everybody has a great evening and hope you guys have found this helpful.
We
Thank you
did.
so much.
Thank you,
Thanks,
Brian.
Brian.
Thanks. Y'all take care.
You got it. Bye-bye, Brian.